Hey guys, my name is Mike Boyd, this is the Money Flare, and in today's video, I want to talk about two important concepts that I'm not sure many people are aware of, which are leverage and convexity, and the risks associated with both. And I think understanding how leverage and convexity work, and how taking on too much leverage can potentially wipe out your portfolio, is crucial for every investor to help avoid making some very expensive mistakes. The most spectacular recent example of this is what happened to Bill Hwang at Archegos Capital, who might hold the record of losing the most amount of money in the shortest amount of time. It was truly mind-blowing to think how quickly the fund collapsed. I made a video about a month ago about all this when it happened, so please give it a watch if you haven't already seen it. And in that video I mentioned how using leverage can be risky, but I didn't really go into the details. So let's go through an example to explain how leverage or margin works and how it substantially increases the risk you're taking in ways that aren't really intuitive at first glance. So suppose you have $1,000 to invest and you're looking to buy the next best growth stock which you think can shoot up to the moon GME style. So you go all in and the stock doubles, so it goes up by 2. And as a result, your $1,000 initial investment is now valued at $2,000, which is a 100% gain. So the math there is $2,000 market value minus $1,000 initial value divided by $1,000 initial value equals 100%. So you're doing great so far, but then suppose that the stock were to quickly crash 50% in a week. You'd be back at $1,000 and now you decide to sell and sit out of these crazy markets. And so overall, you started with 1,000 and you ended with 1,000. So you experienced a lot of volatility, but you lost no money. You might have sold your pants a little bit, but that's about it. And so this is your typical unlevered return profile, which is just a simple linear function equivalent to y equals x. So if your investment goes up 10%, you make a 10% return. And if it goes down 10%, you lose 10%. So pretty simple. Now take that same scenario and that same stock which goes up 100% and then crashes 50%. But now suppose that you used margin or leverage instead. So once again, you have $1,000 to invest, but now you decide to also borrow another $1,000 and invest it as well. And so in total, you have $2,000 that you have that you can invest in that growth stock. And so if the stock doubles, then your investment is now valued at $4,000, and you've essentially made a $2,000 return on your initial $1,000 investment. So you have $4,000, but you need to return the $1,000 that you borrowed. So your gain is $3,000. And if you go through the math, it comes out to a 200% gain, which is twice the gain of the stock and twice the gain of the unlevered example that I described earlier. So by borrowing the same amount of money that you have to invest, you're essentially using 2 times leverage. So for every 10% gain in the investment return, your portfolio goes up 20%. And this can also be modeled as the simple linear function y equals 2x. So the return profile is similar to the unlevered position, but it's much steeper. So the key takeaway here is that using leverage steepens that return profile. All right, so let's continue with the example. So as I said, your investment is valued at $4,000. $3,000 is your unrealized gain, which is money that you keep if you sell, and $1,000 is borrowed money, which you need to return. And so at the beginning, you were 2 times levered. So you had $1,000 and you borrowed $1,000. But now, since the investment is up so much, you're less levered. And so you only have $1,000 of borrowed money versus $3,000 of unrealized gains. And so you'd like to remain 2 times levered. So you decide to borrow another $2,000 to maintain that ratio. Now your investment is at $6,000, which is $3,000 of your unrealized gains and $3,000 of borrowed money that you have to return eventually. Now the stock drops 50% and your investment is valued at $3,000. So it's a pretty big hit. So you decide you've had enough and you decide to sell and you need to return that $3,000 that you borrowed, so you give it all back. And so overall, you've lost all of your initial $1,000 investment. So you've been completely wiped out. And you might be thinking, how can that be? When using no leverage in that same scenario, you lost no money, but using 2 times leverage caused you to be completely wiped out for the same stock price movement. Well, that's because using leverage amplifies the gains and losses in a linear fashion. So if you look at the return profile again and see how it's steeper on both sides, using incrementally more leverage increases the risk to the upside and the downside. So while being levered and using margin can be great on the way up, it can be pretty deadly on the way down. A 50% drawdown can wipe you out with 2 times leverage. A 25% drawdown can wipe you out at 4 times leverage. And only a 20% drawdown can wipe you out at 5 times leverage. We saw many examples of the risks of leverage during the March 2020 sell-off, And one infamous example is the ETF JNUG, which is a 2 times levered ETF of junior gold miners. So it follows the junior miner ETF SGDJ, but the gains and losses are multiplied by 2 since it's a 2 times levered product. And ever since November 2018, junior gold miners have been on a strong upward trend, rising 87% since September 2019. JNUG was also performing very well, but then March 2020 came along, and junior gold miners fell around 47% in the crash, and due to its leverage, JNUG collapsed 97%. And remember that you need to be up way more than 100% to recover from a 97% drop. You need to be up actually 3,233.33% to be exact. And while junior miners recovered nicely from the lows, rising around 148% to make new highs, JNUG barely recovered any of the losses. Overall, since September 2019, junior miners are up 87%, while JNUG is down 77%. And I'm almost certain that this ETF won't ever see that loss recovered. And that's the truly scary risk of using leverage, especially using levered ETFs like JNUG. You can't predict what will happen in the market, and there are often black swan events, so events that you just don't see coming, events that come out of nowhere like COVID, which often send markets plunging. And so you don't want to be caught using too much leverage and potentially wiping out your account when that happens. So please, whatever you do, avoid levered ETFs at all costs, or at least as much as possible. They may work for you in the short term, but if and when a market downturn arrives, it can definitely end pretty badly. Overall, using leverage gives you very little margin for error. If you're right, then you're right in a big way, and your gains are amplified. But if you're wrong, you can lose pretty big. And while I would never say that all leverage is bad, clearly there is a limit when the risk reward becomes far too steep. And so using some leverage can be good if you're right, but managing that leverage is key. And it's very hard to do for most regular investors, most professional investors, in fact. So I would say just keep away entirely and avoid ending up like Bill Hwang. Unfortunately, not many investors take that advice. Archegos wasn't the only one using excessive leverage. Margin debt right now is at all-time highs, and the number of inflows into levered ETFs is at all-time highs. Investors are piling on the leverage, which inherently makes the market much more fragile and susceptible to sharp corrections when those investors start losing big time. But excessive margin can go on for a while without any major issues, so I'm not calling for a market crash tomorrow. But eventually there does come a breaking point, and whether or not we are approaching that point remains to be seen. A much better way of amplifying gains while limiting losses is to implement convexity rather than leverage. And Harley Bassman, known online as the Convexity Maven, often talks about this concept, so I'd recommend anyone to check out his website. But basically, while leverage amplifies the gains and losses in a linear way, convexity bends that return in a non-linear way to either the upside or the downside. A positively convex trade is one where you could potentially gain much more than you can lose. And a typical return profile would be the function y equals x squared. So suppose you buy a financial product which costs, let's say, $5, but it has a return profile of y equals x squared. So that means that at most you can lose $5, while your potential gains are an exponential function rather than a linear one. This is the power of convexity, and while it's not always easy finding investments which can provide positive convexity, it's definitely doable. Any investment which may have much more potential upside than downside would offer some promising convex opportunities. So a common example would be stocks in March 2020, or silver in 2010, or GameStop earlier this year. Oil at negative $37 was also a pretty damn convex bet. Taking advantage of these opportunities rather than simply using leverage is a much better and safer way to get strong returns. And it takes a constant reevaluation of your potential risk return profile. How much can I theoretically gain versus how much can I theoretically lose on any particular trade or investment? So for example, Tesla in February 2021, so just a few months ago, when it was at around $880, was definitely not a very convex trade. It had already gone up around 1,120% since the March lows, and it was extremely elevated at a time when interest rates were rising. And so any evaluation of the risk-reward profile would have found that the potential gains were small compared to the potential losses. And so there was really no convexity there. A classic example of convexity is an option, such as a call option or a put option. And I briefly explained options in a previous video. And what I said back then is that an option is a levered financial product linked to the price of an underlying asset. So most large stocks have options that you can trade, and they move in response to the stock price, but they move much more. So let's say the stock goes up 5%, the option may go up 30%. But using the word leverage here is not correct for options, because in reality, options are convex trades. They have extreme positive convexity, and they are an interesting way of incorporating some of that into your portfolio if you know what you're doing. So for example, take the return profile of a June 18th 415 call option on the S&P 500, so the ETF SPY. And as of recording, SPY closed at around $406 today, and so a June 18th 415 call option would be making the bet that SPY can reach 415 or higher by the expiration date of June 18th, which would be a 2.4% increase in the ETF. And it would cost you $550 to make that bet. And over time, the option price would go to zero if the price of SPY closes below 415 by the expiration date, and it would increase exponentially for any price higher than 415. So if SPY hit 420 by June 3rd, for example, which is a 3.4% increase, the call option would increase by $370, or a 67% increase. If SPY continued to increase, then your gain would theoretically be infinite, and so your max loss is only the price that you pay for the option, and in this case, it's $550. And that's a classic positive convexity profile, similar to the y equals x squared profile that I showed earlier. To achieve the same absolute return of $370, you'd need to have $10,882 invested in SPY, or $5,441 invested in SPY using 2 times leverage. So using call options in this case is a much better way of achieving significant returns while also limiting your risk. So I hope I've been able to turn all of you off the idea of using leverage. In my opinion, using leverage is the least efficient and least elegant way of trying to achieve greater than average returns. Risking your capital using leverage can work when you're right, but it can blow up in your face in spectacular fashion when you're wrong. And everybody who invests is wrong at least 50% of the time, so you don't want your losing trades to completely wipe you out. Be smarter investors, avoid leverage, and seek out positive convexity as much as possible. Overall, I wouldn't recommend any new investors to play with options because they can be very risky and you can lose a lot of your money if you don't know what you're doing. So for most investors, I'd say stay away from options, and the best way of finding convex trades is by taking advantage of severe market discounts, so like in March 2020, or taking advantage of investments with very promising potential risk-reward profiles, whether they be sectors or individual companies. For example, in my previous video, I talked a lot about uranium, and I think uranium has a ton of positive convexity. The same thing with energy companies. I think there's a lot of potential upside versus not very much downside. And so I think that has a lot of positive convexity. And obviously it's much easier said than done, but I think the opportunities for convexity are always out there. Remember that none of this should be taken as financial advice. I'm not a financial advisor. I'm just simply providing my opinion in the hopes that it can help anyone avoid making any costly mistakes. And so with that being said, thank you guys as always for watching. Please be sure to like and subscribe, and I'll see you at the next video.